Welcome back to In Your Money. My guest this evening is Werner Vos. We are discussing what happens in the event of death of a spouse or death of a family member, and if you're living abroad, what the implications are to get those funds out of South Africa. So Werner, I want to bring a cap to the end of the subject, but a question for you. So someone who has left South Africa, who's worked in South Africa with a tax number, what advice are you giving the parent of that individual to ensure that it's easier, an easy process to transfer money offshore? What should they do now versus waiting for the death of the person?
If you want to be proactive, I would recommend that those parents assist those children with bringing their returns up to date. Because once you're up to date, Bryan, it's very easy to file a non-resident zero return every year. It's a press of a button. It's very simple.
Okay, so Werner, if you don't mind, I am going to give out your email address at the end of the program. Maybe someone would like to contact you, or alternatively talk to their own tax consultants. But Werner, I'd like to get into a couple of questions for you. I briefly mentioned the budget. Please comment on deadlines. What happens if you estimate a figure below your taxable income? Does one pay interest, and what about penalties?
Okay, so this month is the provisional tax deadline month for provisional taxpayers, and that's by the 28th of February 2026. So you have to submit an estimate to SARS and make a provisional tax payment, being your second provisional tax payment for the year. So the deadline, just keep one thing in mind, because the 28th is on a weekend, the last day you can file and pay is therefore the 27th of February before close of business. So the objective of this period, or the submission of this return, is in order to do a calculation, an estimate of your income for the entire year, include capital gains, calculating your tax, and then making that payment to SARS by the 27th of February.
Maybe even earlier, maybe Werner, maybe 25th earlier, or 26th, because sometimes there's delays, through the banking systems.
The systems do take a lot of strain, and many times in the past we've come across situations where the system couldn't handle the payments on the last day of a month. So I do advise to try and do it a day or two before the end of the month. The implications for not estimating, or underestimating, I should rather say, is that there's a 20% penalty on the difference between what your ultimate tax liability will be and what your estimated tax liability was. That differential carries a 20% penalty. And then on top of that, if your payment is made late, you get another 10% late payment penalty as well. So this is, from a tax point of view, probably the most important month in the tax year.
You know, just for our viewers to understand, when I last saw Werner in January, he had black hair. And now the tax, you can see how grey he's gone just in the month of February. Werner, let's talk about capital gains tax. Firstly, let me make the comment to our viewers. It's only realised capital gains, not unrealised capital gains. But Werner, I always get the question, I've shown a tax loss, and if you think about it, in Rand terms, you could have shown a tax loss because of the strength of the Rand. The point I'm making is, are you able to write that tax loss off against any other income? Or is it only a tax loss against future capital gains?
From a capital gains tax point of view, capital gains losses can only be offset against capital gains and not taxable income. So those losses will be carried forward, and you can utilize them at any time going forward. You don't lose those losses.
Okay, well, I'd like to get some emails now. Laura in Houghton says, how difficult is it to remove current trustees and appoint another trust company? And are there any tax implications by changing the trust company but not the investments?
Okay. Bryan, to change a trustee is done by way of a resolution passed by the trustees, and then submitting that resolution to the master to capture on their system. As far as the changing of trustees and tax considerations is concerned, the changing of trustees will not lead to a tax event. For a tax event to take place from a capital gains tax point of view, there has to be a disposal or a deemed disposal. When a trust owns assets and the trustees change and there's no change to the assets, there will be no capital gains tax events.
Yeah. I think Laura says she's got an offshore trust. I think I left out the words offshore trust, which means she's got professional trustees. How does she go about changing trustees?
It depends obviously on which jurisdiction you are registered, but normally the same principle as resolutions apply. So you also can do it by way of resolution. But remember, changing foreign trustees is not very easy, because you will find that the trustees taking over would not always be prepared to take over their trust. They would prefer to create a new entity and be professional trustees of that particular entity. And that sometimes could lead to a scenario where if you create another trust, you have a problem. Because remember, Bryan, from a legal point of view, the trust must remain the same person. Yes, you can change trustees, but you cannot change trusts. So that is an area where we've also noticed a lot of people run into problems in the past.
Okay, because I have a lot of people saying they get no response at all from international trustees, but that will take off air. Jack in Rondebosch says, how does the voluntary disclosure program deal with assets that someone had offshore but never disclosed them before?
Well, the principles with voluntary disclosure is that you've earned taxable income, be it income or capital, and you fail to disclose that to SARS. So, for example, you could have had a foreign asset that generated no taxable income in what we call, like, for example, a roll-up fund. And until you sell the investment and generate that gain or realize that gain, there's no reason to disclose. However, if you have earned income and capital gains over a period of time and fail to include in your tax return, then obviously there's an opportunity for you to apply for voluntary disclosure to regularize these assets and pay your taxes. Just keep one thing in mind: if it comes to regularization, the full taxes remains payable as well as interest.
No penalties.
No penalties, or no underestimation penalties.
Yeah, Vern, I know the other one is a little bit more of a hot potato, where you talk about roll-up funds. Then you would be responsible to report, because you don't go to the Reserve Bank anymore. Can you still disclose those assets under the voluntary disclosure program?
I'm not sure if it's an exchange control question or a tax question.
Exchange
but on
control.
the tax side, you can obviously regularize.
I think it's an exchange control question.
Well, exchange control regularization still happens, Bryan. We still do many of those.
Yeah.
So if you've got assets abroad that's in breach of exchange control regulations, yes, you need to approach the Reserve Bank via an authorized dealer to regularize those assets.
Werner, can one do that on a no-name basis?
Actually not. So unfortunately, if you make that decision, then you are stuck in that situation, whichever penalty exchange control may impose. However, there's always been a sort of a gentleman's agreement at the Reserve Bank that if you approach them voluntarily, that they will impose the least amount of penalties possible.
What would you call the least amount of penalties?
Well, zero. It depends on the contravention. Yeah. You may have inherited assets from a non-resident prior to 1997. That's what we call a technical breach for not informing the Reserve Bank and bringing that to their attention. In those cases, you can regularize for virtually no penalty.
Okay, well, I won't take you any further, but let's talk about Leonard in Parkview says, are there advantages to make higher contributions to retirement annuities, both during the build-up phase, when investment growth within the fund is tax-free, and ultimately when the benefits are paid out at retirement?
Well, obviously, increasing your retirement annuity contributions to the maximum threshold of 27.5%, limited to 350,000 Rand a year, is an opportunity to get SARS via tax reduction to contribute towards those contributions. So it would be a very good investment from that point of view. Secondly, the build-up in the fund is not subject to any form of tax in South Africa. But when you withdraw, in other words, when you start taking an annuity, the annuity is fully taxable down the line.
Werner, I want to get one last question and that is, how does one pay estate duty and CGT from an estate in the deceased if there's only properties and properties haven't been sold?
Well, you've got to distinguish there between leaving your estate to a spouse, where there's a complete estate duty and capital gains tax rollover, and leaving it to people other than persons other than a spouse, like children. In that particular case, there's unfortunately not a capital gains tax and estate duty rollover. So in those cases, it could create liquidity concerns if you've got capital gains tax and estate duty to pay and there's not enough liquidity. In some cases, the heirs may be forced to sell assets to be able to pay those taxes.
Well, that's the problem, selling property assets, particularly in Johannesburg. But that I'll deal with in another program. I hope the solution to assist your children who have left South Africa has been helpful. And if you'd like to get in touch with Werner Vos, his details are 011 463 5566. He's also email at tax@wernervos.co.za. Werner, thank you for joining me this evening. Really appreciate it. It's important to note that our program tonight is to provide information and should not be construed as advice. Next week's program will focus on investments, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.